Welcome back to another explainer. Today, we're unpacking the structural market view and the Q1 2026 financials of a truly fascinating company, Cohen Steers, ticker symbol CNS. This asset management firm is making some absolutely bold calls about where the global economy is heading right now. And as you'll see, their latest numbers tell a super compelling story about exactly how they're positioning billions of dollars in response. Okay, let's dive into this. Here's our roadmap for the explainer. We'll start off with the macro market shift, then move into their Q1 financial scorecard, break down their assets under management, check out the dividends and yield, and finally wrap things up with what insiders and Wall Street are up to.
Starting with Section 1, the macro market shift.
So the leadership team at Cohen Steers, they aren't just reacting to the next quarter. They're stepping back and asking a really critical question. Is the global economy undergoing a structural transition? And according to their Q1 earnings call, the answer is a resounding yes. We're basically moving away from those familiar, comfortable trends of the last 30 years, and it's forcing a massive change in how assets are allocated.
They actually break this whole transition down into four major pillars. First up is deglobalization, or, geopolitical fracturing. We're moving away from friendly global trade into this fixed asset investment boom. Second, we have AI and technological disruption, and this is a crucial takeaway. They highlight that AI is ultimately a hardware and power capacity story, not just a software one. Third is inflation uncertainty. And fourth, the end of the low interest rate era.
Let's actually zero in on that inflation piece for a second. John-Young Che, their chief investment officer, stated, Cohen and Steers forecasts consumer inflation to average 3% annually in the U.S. over the next 10 years, significantly higher than the Federal Reserve's long-term 2% target. Now, why does this matter? Well, this persistent inflation metric fundamentally matters for your portfolio because the very investments we need to build out AI and reindustrialize are themselves highly inflationary.
On top of that structural inflation, we've got immediate geopolitical volatility to deal with. The firm notes how recent conflicts in the Middle East and U.S. operations in Iran in early 2026 have really shifted consensus expectations towards stagflation fears. It's this specific uncertainty that's driving a rapid shift in investor sentiment, pushing capital toward tangible, reliable assets.
So where exactly does the firm see the big opportunity here? Real assets. They use this brilliant metaphor, describing real assets as the picks and shovels of the global economy. Basically, in this new capital-intensive world we're entering, things like infrastructure, energy, and real estate are the absolutely critical tools required for growth.
All right, moving on to Section 2, the Q1 financial scorecard.
Now that we kind of grasp the macroeconomic theory they're playing with, how exactly did Cohen & Steers perform? Well, in Q1 2026, they brought in $145.6 million in revenue. I mean, that is a very solid 8.3% increase from the $134.5 million they reported in the exact same period last year. And that bump is driven heavily by higher average assets under management.
Now, what's really interesting here is the bottom line growth. Look at this. Q1 2026 earnings per share came in at 82 cents, up from 77 cents a year prior. And what makes this jump so incredibly impressive is that they achieved this clear year-over-year growth despite facing a significantly higher effective tax rate of 27.4% this quarter.
Let's just quickly run through a few more supporting figures to confirm their financial health. Net income hit $42.4 million. They maintained some seriously strict expense control, which resulted in an operating margin of 34.4%, and they're sitting on total liquidity of $343 million. Simply put, the firm's balance sheet right now is incredibly robust.
Section 3. Assets under management.
Taking a look at the actual assets the company manages, their massive $93.1 billion portfolio is highly diversified across their business vehicles. Open-end funds make up the biggest piece of the pie at $44.8 billion. Then you have institutional accounts representing a hefty $36 billion, and closed-end funds accounting for $12.3 billion. And here's the kicker. That asset base is growing, $497 million. That massive number is their total net inflows just for Q1. To put that into perspective for you, this represents positive organic growth for the firm in 6 of the last 7 quarters. In what has been a pretty tough market, clients are actively handing them more money.
So why the inflows? Well, it's driven by elite performance. 86% of their assets under management beat their one-year benchmarks. And even more staggering, 95% of their open-end funds are rated 4 or 5 stars by Morningstar.
This essentially proves that their real asset strategy is hitting the nail on the head and working exceptionally well for their clients.
Next up, Section 4, Dividends and Yield.
For the retail investors out there who care deeply about how the stock rewards them directly with cash, let's see how this builds. Just look at this consistent payout timeline. Back in 2025, they were paying 62 cents a quarter, but check out early 2026. They bumped that up to 67 cents in March, and they've already declared another 67-cent payout for May.
At the current stock price, that gives Cohen Steers a dividend yield of 3.64%. For income-seeking investors, that is a highly attractive metric, especially since it's safely backed by an 85.4% payout ratio. It shows a really fantastic commitment to rewarding shareholders while making sure they safely maintain the business.
Finally, Section 5, Insiders and Wall Street.
Looking at how the market is behaving, Wall Street analysts have a pretty wide range of expectations right now. UBS actually has a high price target of $102, but interestingly, they also issued the lowest target at $63. The consensus target among analysts sits right around $77, which implies a modest upside from the current trading price of roughly $73. So it's a balanced, objective view from the outside.
But here is the crucial point. Look at what the insiders are doing. Over the last 6 months, there have been 24 open market purchases by insiders, compared to just 3 sales. That is an absolutely overwhelming ratio of insider buying momentum.
And we are not talking about small numbers here either. Executive Chairman Robert Hamilton Steers purchased over $11.2 million worth of stock. Martin Cohen made purchases totaling roughly $5.9 million. These massive, multi-million-dollar buys show an intense personal confidence from top executives in their own hard asset strategy. They've got serious skin in the game.
Which leaves us with this pretty provocative question. With rising inflation and AI's immense power demands completely reshaping the economy, are real assets the ultimate portfolio hedge for the next decade? Cohen Steers absolutely believe so, and honestly, their financials and insider buying speak volumes. Thanks so much for joining me for this explainer. I hope it gave you some fantastic insights to chew on, and I'll catch you next time.